It's now my privilege and pleasure to welcome our featured speaker of the day, Sherwood Dodge. First, I've just got to tell you, before making the introduction, I asked Sherwood a little bit about his background and his language skills, because Sherwood was born in Louisville, but at a very young age moved to Thailand. And as you'll see in just a minute, Sherwood doesn't have much of an accent. And I said, "You really don't have much of an accent." And his answer to me was, "You know, the Thai people tell me I don't have much of an accent in Thai either." Wow. I barely have English down, so that's very impressive. Mr. Dodge is president and CEO of GE Equity, a unit of GE Capital Americas, which is the private equity arm of General Electric. His 24-year career with GE Equity began in 1988 in Chicago as vice president of the commercial financial services division, where his focus was leveraged loans. Sherwood grew up in Asia, and in 1995 he returned to the continent of his youth and became the president of GE Capital Thailand. For 3 years, he bought and built businesses providing auto leasing, sales finance, equipment finance, and credit cards throughout Asia. From 98 to 99, Sherwood moved to GE Capital Mortgage Corporation, where he managed and grew mortgage insurance and mortgage lending operations outside of the United States. Ever the globetrotter, Sherwood joined GE Equity in London in 1999 as its managing director of GE Equity Europe. He spent 7 years with the European business, making investments in more than 50 companies in 15 countries. Sherwood would return to the U.S. in 2005 and has served in several capacities with GE Equity, including responsibility for GE's investments in the aviation and energy industries, really growing areas, and overseeing co-investments with the customers of GE's global sponsor finance business. Sherwood graduated from Denison University in Ohio with a bachelor's degree in political science, and before joining GE Capital, he began his corporate finance career at Chemical Bank. Now living in Fairfield, Connecticut, with his wife and 2 sons, he is the business leader of GE Capital Americas. As an active mid-market minority investor, GE Equity leverages cash flow, industry knowledge, operating talent, and global reach to maximize the return of GE's investment capital. Sherwood also leads the team that is responsible for acquiring and divesting businesses and portfolios for GE Capital Americas. It is this wealth of experience that Mr. Dodge is drawing upon this morning to talk about private equity, bringing good things to life. He's excited to be joining us here at Terry, and we welcome him enthusiastically. Thank you, Sherwood.
Thanks for that, Ted. That was quite an introduction. I know some of you have jobs you need to get to, and and I think I can dispense with a piece on my own background at this point. But it's great to be here this morning, especially given the hour and the day of the week. I'm really impressed with the commitment that you all are showing. What I thought we'd do in the next 30 minutes or so is talk about 3 or 4 different things, as the name of the talk suggests. I think we'll talk a little bit about what we do as GE Equity, where we invest, how we invest, talk a little bit about market conditions, and then I'd also like to spend a little bit of time talking about corporate venturing generally. It's something that is beginning to come back a little bit, and I think it's something that would be interesting. So we'll do all that. Again, as Ted said, I did grow up in Thailand. I did go back there as a professional with GE, and one of the great things about GE is you can have 4 or 5 different careers in the same organization. And so again, I feel blessed to have been able to do that. I've spent the last 13 years, I guess it is now, in the private equity industry, and feel like that's where I've really made my home. But it is a great organization, and it's great to be able to do so many things in a single company. Let's see, do I have the clicker here? Yeah, here we go. So first of all, just to level set you in terms of the GE organization, I think everybody has a connection to GE in some way, shape, or form, right? You either own one of our appliances, or you've been on a plane and it has one of our engines or whatever. But I think very few people get to see the full breadth of what it is that we do. So I thought it was worthwhile just to show you that, and that will also play into some of my comments later about what we do and why we do it. So as you can see here, a number of components, and in total about $147 billion in revenues last year and about $14 billion in net income. So, big, but again, I think part of the way in which we've been able to do that is to think about these businesses in very small units, run them in small units, and get the growth in small units. I think the other thing that's worth mentioning here is that since Jeff Immelt became the CEO about 10 years ago, he's had a very strong focus on leading with technology. So he's got a very strong belief that technology really in the longer term represents your competitive advantage. And so a lot more money has gone into the R&D of these businesses than had prior to that. The other thing I think that's worth mentioning and that has been in the news or was in the news a lot back in the 07-08 timeframe was GE Capital and the amount of net income that GE Capital represented. At the peak, it was about 50% of GE's earnings. Obviously, since the financial crisis, that number has come down. We used to be at about $660 billion in assets in GE Capital. And again, we've now purposefully shrunk that down to about a $440 billion level. And we're going to keep it there. So it's a much more focused business, GE Capital is today, than it was. We've got limited capital. We need to deploy that very strategically. And we're going to keep GE Capital in the 35 to 40% of GE's earnings from here on out. Let me see if I can figure out how to work this. No. All right, let me just spend a minute on the two pillars of GE's global strategy. And again, you may have seen some of this in your own, as you go about your lives. We've been talking about GE in terms of these two pillars for the last sort of 3 to 5 years. The first campaign that came out was the Eco-Imagination campaign. And again, the idea here is that conservation is good for everyone, not just for the company, but it also benefits customers, investors, etc. And again, I want to work this into the talk because it's a bit of a departure, I think, from the mindset that we've had prior to this, which is not in GE, but just generally in corporate America, that this is a win-lose or a zero-sum game, that in order to get profits, you need to sort of take that from somebody else. I think our chairman's view and our view is that is not the case. And in fact, Michael Porter, back in about a year ago, wrote an article in the Harvard Business Review about a concept called shared values. And as I think about where we are in our journey as an organization, as a company, it has a lot of those traits. And the idea of shared value is that businesses can solve large social problems and in the process make good money doing it. And that is sort of where we need to go in terms of what the role that corporations play in the world. So again, the first pillar, Eco-Imagination, again, green is green, meaning being conservation is something that is good and you can also make money doing it. And the second around health imagination, which you've probably seen, again, it's been one of our campaigns, and this is around the whole concept of health is wealth. So if I just take you a little deeper into those. So Eco-Imagination specifically, again, is pretty broad. It cuts across and applies to all the GE businesses, both service and manufacturing businesses. And you can see the components there that we laid out for ourselves a couple of years ago. So between 2010 and 2015, investing more in R&D, $1.8 billion was the number that we are going to hit. Increasing revenues from our eco products, 22 new products, reducing our greenhouse gases, and reducing our water usage. Looks like it's 22% since 2006. So again, while it cuts across all the businesses, I think it's particularly impactful for the manufacturers within GE, because in addition to everything else, it actually affects the products that you're going to offer to your customers. So very impactful. The second pillar is health imagination, and as it says here, this was a 6-year, $6 billion strategy, and it really has 3 prongs: reducing the cost of healthcare, improving the quality and efficiency of healthcare, and increasing the access to healthcare. And again, as you think about where we are as a society, these are obviously three prongs that are very relevant for where we are both as a society and in terms of governmental policy. So having given you that sort of basis, let me talk a little bit about what I do and then relate what I do to what I've just shown you in terms of the pillars of GE strategy. So at a high level, GE Equity is a center of excellence for investing, and we've got the full infrastructure for investing. So we know how to underwrite, we know how to document, we know how to manage the investments post making the investment. And we really have two prongs in our business. Or two competitive advantages would be a better way to say it. We try to leverage the deal flow that we get from being part of one of the large financial services companies in the U.S. And so, to give you an example, we have a sponsor finance business that plays in the middle market that's very, very good. And they probably see 150 to 170 transactions a year that they complete. We will look at that deal flow and say, those are great debt deals. Which of these are good equity deals as well? And then we will execute on, say, 50 to 60 of the ones that we feel are best, where we like the sponsor the best, et cetera. The other part of our business, and the part that is probably more relevant to the conversation today, is leveraging the industrial knowledge of GE. And we've specifically focused on energy and healthcare, again, in keeping with the eco-imagination and health imagination themes for the business. So as I look at the private equity community, if they had the resources that we have in terms of being able to tap that industrial knowledge, they would tap it heavily. And indeed, that's what we've been doing. So again, as it says here, we make minority investments, non-control investments. We tend to invest small, especially now that we're regulated by the Fed. We like sort of smaller bite sizes. We want to keep a diversity of risk. In total, it's about $3.4 billion in assets that we manage, and that's in 250 direct investments and probably another 450 fund investments. So it takes a lot of people, as you might imagine, to do that, as well as make 60 to 70 new investments a year. And as you can see here, we've been doing that since 1995. And now, one of the important things to understand is, while some of our investments might actually advance the GE strategy, we invest to make money. I don't get any break at the end of the year if I say, well, no, I didn't make any money, but I advanced the GE strategy. That is not going to cut it. And I think that's a little different. We'll come on to corporate venturers generally, but that's a little different than the way some people approach it. So I think we've done ourselves a great service by setting out our stall that way, by setting our motivations out in that way, and by making sure that we continue to make money while we do what we do. And within that, if we were to talk about specifically about what we do in energy and in healthcare, we've got two vehicles that we have set up in order to make investments in those two fields. So the first is here. It's called Energy Technology Ventures. It's been up and running for about a year. This one is unique in that we actually have capital from some third parties. So as you can see here, NRG and Conoco have joined us. It's about a $300 million pool that we put together. We put up half the money. They put up half the money. And we generally lead this, and actually Lisa is the compliance officer for this joint venture as well. So, and again, the focus is primarily energy and clean tech, as it says here, but this is the way that we go about investing. And one of the great things about this is, again, that you're getting, in this case, almost 3 corporate venturing activities in one. We can leverage all those companies. And again, one of the advantages here of doing it this way is not just that you get better deal flow, you also get better underwriting. And in the end, it's really about what you do after you make the investment. And having 2 other partners that might be able to help us create value in these investee companies has been very helpful. So that's our Energy Technology Ventures vehicle. The second vehicle that we've set up is to invest in healthcare, and this is all GE money. So there's no third-party investor here. But having said that, there are 4 participants, as you can see. So GE Healthcare, who obviously brings a lot of knowledge, huge organization, very good, big diagnostic company, increasingly in the life sciences business as well. And then our Global Research Center. The last time I was on the campus up in Schenectady, I think they have 2,600 PhDs there. It's a stunning place. You walk onto the campus, you know immediately you've got the lowest IQ for a mile. It's just one of those places you'd like to leave as soon as you can. But they are there. They're on the committee. They're very, very helpful. And for them, obviously, what this does is as they see all of these new technologies, it helps them see around technology corners as well. So very helpful for them. So we gain, they gain. We also, within GE Capital, have a GE Capital Healthcare Financial Services business. A lot of domain expertise. They focus on debt. But again, we leverage their deal flow to bring their debt deal flow, as I mentioned earlier, to bring equity opportunities in. And then my own GE Capital Equity business, which again brings more of the market knowledge about what's going on not in the industry, but more in the private equity industry. So what are the right terms today? How should we document this? The last time we did it this way, was it good or bad? And bringing some of that knowledge to bear. So let me transition from that to the other big dynamic as we invest, which is market conditions, obviously. And I'm going to break this into 2 pieces. We'll talk first about the private equity industry, which I view as more the more mature part of the industry. So these are the leverage buyouts, the companies that are already profitable, can support debt. And then we'll talk about the venture on the next page. So listen, we're in an interesting place right now in the private equity industry. I think, obviously, it became very difficult in that 2008-2009 timeframe. And as a result of the public markets pulling back, a lot of the investors, whether they were pension funds or endowments or family offices, found themselves over-allocated on a percentage basis to this asset class, which they think of as alternatives. Alternatives, that is, to the bond market and to the public equity markets. And as a consequence, they pulled back. The other thing that we've had here is, you're probably all familiar with the Dodd-Frank Act, and specifically within that, the Volcker Rule. And this was legislation that was a reaction to some of the crisis that we suffered in the 2008-2009 timeframe. And with with good intent and to keep the banks safe, they've now been prohibited from investing in private equity funds. And it might also be that they have to exit the funds that they're already in. We are going to be deemed at some point part of that. We do have a couple of banks in our structure as GE Capital, and so we will be complying with the Volcker Rule as well. But as a consequence of that, probably 10 to 15% of all the equity in the system isn't there anymore. And on top of that, what we're seeing is that a number of the players, the investors, are getting much more focused, wanting to put their money, instead of over 50 funds, pick the 10 best and really focus their activities there. And so as a consequence of all of those forces, we are, I think, beginning to see a shakeout in the private equity industry. But at the same time, right now, it feels like we're in a position where the deal flow is coming up very quickly. From a deal flow perspective, it feels to me right now like 2007, both in terms of the volumes, and this is really in the last 6 months, both in terms of the volumes, as well as in terms of some of the terms on the debt side that the private equity investors are able to command. So we're beginning to see covenant light deals again. We're beginning to see leverage multiples on the debt side move from the 3s up to the 4s, the occasional 5s. And obviously, if a private equity house can get a lot more debt, they can afford to pay more. And the other thing that we're seeing is that the the corporates are also, as you know, pretty flush with cash right now. And so you put all that together, and what we're beginning to see are rising prices. Again, so on the price side and on the deal side, it feels like 2007. Having said that, in terms of the underlying economy, it still feels to me like 2003, 2004. So it's a very unique investment environment right now, and I think we just need to be very careful not to get ahead of ourselves in terms of getting caught up in the euphoria around what prices are doing in the market. So that's my take on the private equity side, and then on the venture side. My overall observation would be that it is still difficult to raise venture capital funds. I don't know how many of you have seen the stats on venture capital in the U.S. It's not been a hugely profitable business over the cycle. Go back 10 or 15 years. And I think some investors are beginning to realize that. And then obviously as we went through the crisis, again, you can see there in 2009, the numbers were down quite a bit. We're beginning to get back on a fundraising level, back to pre-crisis levels. But I again think we're going to begin to see a shakeout. I mean, if you're Kleiner Perkins or more Davidoff, and you're on your 5th, 7th, 9th fund, and you've made money for your investors, you're in good shape. But if you are somebody who is trying to raise their first fund today, very tough on both the private equity and on the venture capital side. And you can see that in the chart on the right there as well. There are not very many new funds that are being raised. The dominance there is with follow-on funds. And then I thought I'd just share with you a little bit about where the money is going. And as you might expect, clean tech and healthcare are both areas that are very interesting generally right now. But what I'm seeing within those two areas is kind of a barbell effect. There are quite a few deals, but they're either very good or, there's sort of nothing in the middle or not very attractive. And as a consequence, the ones that are good are attracting a lot of capital, and the prices they're able to command as they raise their B, C, and D rounds are very, very high. So again, it's this very challenging, as we try to put money to work in a responsible way, a very challenging environment. Now we have, I think, some advantages. People like to be associated with a large corporate. We can and do help them with creating value. So in many cases, we will actually sign a commercial agreement with with the younger companies to try and help them distribute their product, co-develop products, and what have you. So again, I think that gives us a little bit of an edge as compared to the private equity or the venture capital fund that is going to help them with management certainly and with some other aspects, but probably doesn't have an ability to take them global overnight, for instance. Sorry, let me just back up there. The other point that I would make here on the healthcare side, just a trend that I think is worth noting, is that it has become so difficult in this country in terms of getting FDA approvals for new products, that we're beginning to see some of the venture money move to Europe and to Asia. And we're actually beginning to see some of the companies that want to launch their products launching there first as well, because they can get a CE mark or whatever it is they require to launch there year or years ahead of when they might be able to get something in the U.S. And it's something that as an American I hate to see. It's just something that's on the radar and people ought to be aware of. So let's talk a little bit about, I've just got one or two more pages, I think it's just two here. Let's talk a little bit about corporate ventures. As I think I said earlier, they represent about 10 to 15% of all the capital that goes into venture capital. And I first became acquainted with this whole side of the venture capital industry when I started in private equity in 1999. And at that time, obviously, we had something called the dot-com boom, later the bubble or the bust. And that created a lot of interest on the part of a lot of corporate venturers got into the business there and have subsequently stubbed their toe and gotten out of the business as well. And what we're beginning to see right now, I think, is a little bit of a resurgence of that. And this is by no means an exhaustive list. This is just, these were a couple of people that we either have come across or know. There was an article in the FT a couple of days ago, some of you may have seen, about the corporate ventures in Germany. SAP was listed, BMW. There are a lot of them that are doing this. And to have a corporate venturing activity, you really need probably at least 100 million of capital. So it's something that larger companies tend to do and smaller companies tend not to do. But in terms of again, trends, one of the things that I'm beginning to see is that the industrials are beginning to do more of it again, but the technology companies in particular, and some of those are represented here with Google and Intel, are really beginning to come into this space. And if you just look at these 2011 investment numbers, look at what a Google and an Intel are doing relative to a Siemens. Right, so that, and I think, when I think about the driving forces for why corporate ventures do what they do, technology, as we all know, continues to advance at a more and more rapid pace. And it's very, very difficult to keep up with it, even if you've got 2,300 PhDs sitting in Schenectady. And I think there's also been a realization, there's always been a realization, but a greater realization on the part of some industrials that a lot of the great innovative breakthroughs do come from startup companies. And so corporate venturing is increasingly becoming sort of a complement to industrial R&D and business development generally, as well as licensing, which is something else we haven't talked about. We probably don't have time to talk about today. But the other interesting thing to think about is, those who have fallen away, why have they fallen away? And again, my own thesis, and it's just my own thesis, is that they do get confused about what they're there to do. It is hard enough, it is difficult enough to make money in this space, to be a good investor. If you then layer on top of that a desire to bring something strategic to the company, and if you begin to confuse those two priorities in any way, then you're probably going to fall down on one or both fronts. And I think, again, I haven't seen it recently, but certainly coming out of the dot-com bubble, we saw quite a bit of that. And so, again, this is just my take, but it feels to me like a lot of the guys who are in it today, they are saying they want to make money, but they do seem to be leading more with their strategy as compared to their need to make a financial dollar. Having said that, a lot of these companies or corporate ventures are very good and have made some very good money over the past couple of years. And then I thought I would close with some thoughts on sort of what's next for corporate venturing. The last couple of years have been interesting times, obviously, to live through. I think, we've seen this, I feel like we've seen this sort of lack of trust develop in the business community generally. And the financial crisis obviously exacerbated that, and a lot of feeling, especially if you're in the financial services industry, that somehow they were profiting at the expense of the broader community. And while everybody has these corporate social responsibility programs and they're good, I think at some level they seem to be having a limited impact. I think they could have a lot more impact. And as a consequence of all that, I feel like we're beginning to see some policies that make it more difficult, will make it more difficult for us to compete. So I'm going to go back to that Michael Porter article and talk a little bit more about the shared value approach. Again, this idea of creating economic value by addressing society's needs. I think it is what eco-imagination and health imagination are. I think GE was mentioned in the Porter article, is given credit for beginning to go down that road. It does make you reconceive your products, your markets, how you want to approach strategy. And again, I see corporate venturing as sort of an integral part of all of that. We need to continue to bring technology in from the outside and invest in startups and use that as a way of supplementing the industrial R&D that we do internally. So again, I would, if I look out over the next couple of years, I think we're going to see more and more industrials wanting closer and closer relationships with the with the venture capital community, and I think you'll see corporate venturing become more central to corporate strategy. So with that, I'm going to wrap it up, and we'll happy to take questions. You bet.
Sherwood, thank you. We have a roving microphone, so
Okay.
if you would, when you ask the question, if you make sure you get the microphone so we get this for the webcast. And what an exciting big picture view. I feel like we've been on one of your GE airplanes. Guess I could have stood up there, Sherwood.
Right.
One of the slides, maybe in about the middle, showed at the top. Maybe go back a few more. Right there, right there. I'm sorry, one more advance. No, sir. How many Terry graduates does it take? Go forward. I'm sorry. We're about the keep going.
What was the topic?
Right, the next one. Next one. There. Okay, the third bullet point shows that 20 to 30% will disappear. I think I know what that means, but you didn't quite spell that out. Are these return expectations for private equity? And
No, actually, and again, this is one man's view, right? But I think what I'm saying here is that if you look at there are a lot of private equity players in the U.S. in particular. And some play at the small end, some play in the middle, and then there are obviously the large names that we all know, like the Apollos, the KKRs, the Blackstones, the Carlyles. I think the large guys will stay. They're there. They're becoming more public every day. Blackstone is already public, as we know. KKR is already public. It looks like Carlyle is going to be public shortly. But I think if you're in the middle, and if you serve the middle market or the smaller end of the market, again, capital isn't going to, unless you've had really good returns, capital isn't going to flow to you as readily as it used to. And so we're already beginning to see, because of that, people who are not able to raise their next fund. So, firms that are not going to be able to raise Fund 2 or Fund 3. I think if you had, generally the market will forgive you for one bad fund. In this market, if you've had two bad funds, you're probably not going to raise another fund. So we're anticipating, I don't think it's this much capital, but if you look at the number of players, and it's probably several hundred that serve the middle market and the low end of the market in the U.S., I'm guessing we'll see somewhere between 20 and 30% by number of those firms in the next 5 to 10 years disappear.
what about your expectations for return on equity?
Yeah, the question was my expectations for return on equity. If you look at the private equity market, now I'm again distinguishing that from the corporate venture market. If you look at the private equity market, where people have been investing in buyouts now for 20 or 25 years, drawing on memory, I think the returns have been on the order of average of 11 to 13%. Which is obviously much better than the public markets have delivered. So, and that's the reason that getting that kind of alpha is the reason that the pension funds and the investors continue to come back to this market. But within that, there's a very broad range of returns, right? Once you drill down, there's a very broad range of returns. So some have returned on average 18 to 20%, and others 2 to 3%. And obviously the fees that they pay, or that they charge rather, are also high, right? So on average, they're charging 2% a year to manage your money, and then taking 20% of the profits. And so, again, you look at that model, and if you have any doubts about whether or not this team is a good investment team, given that business model, you would not invest, because you know you're going to be paying the 2% no matter what. So I think the other thing to think about in this industry is that it is very vintage driven, kind of like the wine industry, I guess, although I don't know much about wine. But there are good vintages and bad vintages. I think the 2007, 2008 vintage was a bad vintage. We were paying very high prices. And if you invested during that period, unless you were pretty lucky, you did not make a lot of money. You would have been lucky to come out with a low single-digit return. I think the 2 years that we just went through were very good vintages. And now my fear is that we're beginning to go back into bad vintage territory. So we'll just have to see.
GE lost its AAA credit rating a couple of years back, probably more due to the capital side of the business versus the industrial side of the business. What was the thinking or the thoughts of the capital team at that time at the loss of the AAA, and do you think that GE will ever regain its AAA rating?
I'm going to decline. I'm here in a personal capacity, and I think that is such a. I don't want to say anything that would suggest that, that I know what the broader capital community felt about losing the AAA. I will say that everybody, including the U.S. government, has now lost the AAA, and that made it a little easier. But look, I think, and I think before that, the market was already pricing us below a AAA, and so I think it's just the reality of the world that we live in. If you've read the press, you'll see that we are working on, in capital, we are working on our funding strategy. We would like to be more deposit funded, and in my other job, which is the business development person for GE Capital Americas, I work on that remit. And we were fortunate enough in December to buy the deposits of the MetLife company. And again, that's all part of trying to diversify our funding base. But what I think you'll see is that we recognize that ultimately what is going to constrain us in terms of our ability to grow is our ability to get attractive funding. And so it's an important component of what we do. It's an important component of the business model. And we'd like to see it more diversified than it is today.
You talked about the importance of startup investments and driving the technology in the market. And I know equity has typically played more on the growth side, consistent with, you talked about the venture market being a more difficult market, to make a profit. And how is GE approaching the startup market through Eco and Healthy?
Yeah, it's a great question. So, again, as you drill down, it just gets more and more complicated, right? And if we were really to talk about the full spectrum, I think about the private equity market. I've been talking about it in two pieces. There's really a third component, which is that piece in the middle where the company has had market validation about its product. We know it's going to sell the product. It's now in a fast ramp mode, Pat, probably where your company is. And we at GE Capital, we like that better. We think there's less risk there, and we're more able, I think, to help companies at that stage of their development. With very young companies, my fear is very often that we're going to overwhelm them as GE, right? Are we just going to make so many demands of them, even if we're well-intentioned, that it just, they're a young company, they've got limited resources, they're not quite ready for all that we want to do with them sometimes. So what I'm trying to do is to make sure that I'm not sure this will answer the question, but I'm trying to make sure that we do both, that we don't get too heavily invested on the venture side, that we do find a number of investments in the growth area as well. But I've got to tell you right now, the good growth capital investments are very, very difficult to find. We're finding more good venture activity. But the beta, the whether or not these companies are going to make it on the venture side is very high, right? They either very typically make it or don't make it. And whereas with a growth capital company, it's more often they're going to make it. It's just a question of what your return is going to be. Did that answer the question?
I would actually, there was a couple articles that came out recently about investments being made and partnering with other venture capital firms on the challenges, on the, like the eco challenges. Is that something that your group manages?
Yes. Yeah. Thanks for the leading question. Yes. Yeah. So there are two specific challenges that we've launched as GE that my team has been able to help with. And one was the Eco Challenge, the other was the Healthy Challenge. Again, we keep going back to those names. It's different from these two vehicles that we just saw, but these were specific pools of money that were put out there to try to bring forward innovation in very specific areas. So in the case of the Eco Challenge, that was around smart grid, right? It's an area that we play in. In fact, 2 days ago, I was out with our GE Energy team here in Atlanta, and they're doing a lot around the smart grid. And as an investor, it's an area that's very interesting to me as well. And so we put out, I don't remember how much money it was. You may have a better idea, given that ETV was the group that helped manage it. But we basically said, here's $50 or $100 million that we're willing to commit to very young companies, mostly as grants. Just bring your ideas forward. And we got, as I recall, 3,000 ideas from that. And we maybe funded 20 or 30. But just a huge influx of knowledge and of potential technology that we can then help to advance. And then the second one was around the Healthy Challenge. Same idea, was launched a couple of years later. And that was specifically around breast cancer technologies, technologies for diagnosing breast cancer. And we're still at the back end of that right now. We just put out that challenge, I think it was 9 months ago. And we've had some great ideas. We've been able to fund some great companies through that. So I think when the companies are that young, to your point, that might be a better way to do it, which is just give them the money and you may or may not get it back. But at least you've seen the idea and you've advanced the technology for society at large.
Sherwood, what sort of trends are you seeing outside of the U.S.? You touched on it briefly with healthcare investments focused in Asia with the challenge that the FDA presents. Are you guys focusing on any other particular country or region?
So my business, again, sits within GE Capital Americas. So I'm very much focused in the U.S., Canada, and to a lesser degree South America. We have a couple of investments in Asia, so I am headed there next week. But they just happen to be there. We do have teams in both that don't report to me, that report geographically into Asia and Europe, but private equity teams in Asia and Europe. Of the two, I would say obviously Asia is the more exciting place right now, and a lot of people are beginning to pile into Asia, which is surprising to me because I would have thought they would have started earlier. But even last year, we were seeing quite a bit of money looking for private equity homes in Asia, and Asia's a difficult market. It's very country specific. Investing in China is very different than investing in India, which is extremely different than investing in Japan, right? These are just significantly, they're just different on every level, right? And so to put a team in place to try to invest in all those geographies, I think people have found to be challenging. So they've gone to more of a country specific model. And a lot of money has gone into India. I don't know what the returns have been. I haven't seen anyone make a ton of money yet. I've begun to see some good returns come out of China. And I think we'll probably continue to see that. But if you're there, you definitely want to have a good local partner. I think that was my observation, spending time in Thailand as well, which is why we had a couple of joint ventures. So, and Europe, you would think Europe would be an area of opportunity right now. Things are pretty chaotic. Prices are down, and yet debt is available. A lot of people are selling. whether it's the banking community or investors that need need liquidity or selling things that they might not want or wish to sell in normal times. And so you would think that there would be opportunity there, but having said that, we're not very active in that market right now.
Sherwood, you mentioned clean tech, energy, and healthcare. Any other sort of subsectors underneath the broader industrial space that you and your team think will be particularly attractive over the next 12 to 24 months?
Well, I would have to get some of the, I've got a team that focuses on energy, and they could go very deep with you. It's challenging for me to do that. I'd mentioned, smart grid I think is going to be interesting, although again, I think some of the play in smart grid is going to be more in Europe and in Asia, and I think we're going to begin to see it slow down a bit in the U.S. In many cases, instead of looking for the areas that are good, we look for the areas where we know something, and then within that, try to find the area that we think is going to be good. So there are parts of the aviation business that we like. Within the energy space, obviously, not knowing whether the production tax credits, the PTCs, are going to be extended by Congress next year here in the U.S., makes for a difficult wind environment, makes for a difficult solar market. Solar has been a challenge in that the Chinese have come into that space in a very big way. Same thing with the wind business. Suddenly we're seeing Chinese companies that are making the towers, the blades, the whole unit. So again, as an investor, I can try to profit from that, but overall, you begin to, when there's that much uncertainty, it's a little bit like the healthcare market. When there's a lot of regulation or uncertainty around the regulatory environment, then it becomes very, more difficult to invest. Any place where there's stroke of the pen risk is a challenge. Yeah.
Thank you. You guys obviously focus extremely heavily on innovation, and as the United States tries to, have a big push towards math and sciences and making sure the United States leads the world in innovation. Right. One of your slides mentioned that the VCs are focusing more on Europe, and part of it has to do to probably FDA and regulations and other what kind of presence do you guys have in Washington? Are you guys trying to change that at all, especially with your group focusing on the Americas?
Yeah, I think again, I'd rather duck that question if I can. In part because I don't know it very. I don't really have a good grasp of the answer. I mean, like every big company, we obviously are represented in Washington, and as you might know, our CEO is heading the Jobs Council, the Jobs Council now, and so has been working with this administration to address some of those issues and try to do that in a very active way. Personally, again, I would love to see us graduating more engineers and people who can create things. And as an investor, if I could do it over again, I'd probably try and go that route. But given that I am where I am, I think you begin to appreciate all the value that engineers and mathematicians and others bring to the equation. And so one of the interesting things in my view in the last year or so is that we're beginning to see the manufacturing jobs come back to the U.S. And that's something that GE is participating in as well. And I think that's a good thing. I think to the degree that we can get back to a better balance between the manufacturing sector and the service sector of our economy, that'll be a good thing. So with that, I'll wish you a happy Thursday. Thank you for having me here, and I hope that was helpful. Thanks.
Oh, okay. All right. Thank you. What a great talk. We have got something special we'd like to share with you, which is a glass sculpture designed by an artist named Loretta Eby, and it's a keepsake for your time with us this morning. So thank you again, Sherwood.
Thank you very much. Thank you.